Thank you so much for investing your time with us on this Tuesday morning in the US and Tuesday night here where I am in Singapore. My name is Kevin Tizay. I work with Bob Daudt at ChinaPlus Capital. I actually reside in Shanghai, but currently I'm in Singapore waiting for China to reopen to foreigners, and I'll be the moderator for this short presentation today. Today we'll be walking through 6 critical options foreign manufacturing operations in China need to evaluate, where we'll be talking about how industry insiders are evaluating their Chinese operations and what potential strategy changes are taking place over the next 12 to 18 months. Our goal is to provide perspective on the changing competitive landscape in China and the services that both ChinaPlus Capital and PRI can offer to help you navigate this dynamic. I know that sometimes presentations like this can run a little long, so we'll try to keep the material around 30 minutes and then open up the line for questions in the last 10 minutes or so. Now with that, I'm going to hand the call off to Dwight, who will talk a little bit about the current economic climate in China.
Thanks, Kevin. And as we move to the next slide, PRI, of which I'm chairman, has had now 29 equity operations in China, most in manufacturing, several thousand employees. We're a family fund, and I have lived in China for most of the last 32 years and have been general manager at 8 operations, 7 in manufacturing. If we go to the next slide, unfortunately, the news for US companies in China is not good. I will take data and examples from the 9 current PRI equity holdings in China. Additionally, we have a consulting division that services over 40 clients, and I'm now in my 17th year as chairman of American Chamber of Commerce China, the Manufacturing and Sourcing Forum, of which there's close to 500 factories in that group. And so daily, this is my life of dealing with manufacturers from the US, doing business in China, having operations in China, or exporting back to the US. I'd like to give a personal illustration. So if you look at the upper left-hand corner on A Long Way to Go, basically the phase 1 deal that was signed in December from a reality standpoint is dead. It simply cannot happen in the short time frame. On the ground in China, I can tell you we're getting very little efforts by China with US to buy US. Their goals are just simply not going to be reached. So the black there tells you how far behind they are in that. It was interesting. One of our non-manufacturing operations is the largest Judeo-Christian values publisher. We're now in our 18th year. We do about 1 million volumes a year. And what's critical to us, about 50% of our business is new titles published in the last 18 months. So that number is an important number. The only limit for us is not financially to do that, but it's getting the Chinese Communist Party's approval to do new books. And as you'll see in the lower bottom-hand corner, that graph is almost reflective of the total shortfall in the in China's purchases of US products or services. And again, we're just finding that the Chinese Communist Party is slowing down approvals, et cetera. If you go to the right side, for those of us in manufacturing, we were optimistic because the biggest jump in the commitments percentage-wise was actually in US manufactured products. And that again is simply not happening. So the impact is, what are the 2 governments that are having all these difficulties talking to each other, COVID-19 having an impact on general trust, and I think rightly so in many cases. The result is that the phase 1 deal can't be done. So there will be no phase 2 in terms of what direction we were hoping, which was a decrease or elimination of both Chinese import duties of US products, as well as the US import duty 25%, on others. I can tell you that one of our operations started in 2006 in electronic engineering combustion gas control. That operation, our largest client, after paying roughly 25% duties on average for the last 18 months, decided that's it. We're going to have to move that particular production to Thailand. So it's not a good situation right now, and U.S. companies have to look at alternative sourcing, what they're doing. Again, we'll talk later in the talk about made in China for China and for China aligned countries. But right now, the phase one deal, the summary is it's simply not being implemented. There will not be a phase two that reflects what we thought was going to be a continuation of this policy, and we've got problems. Bob. Go ahead.
Thank
Bob.
you, Dwight. I appreciate that. It's always good to hear. Thank you, Dwight. It's always good to hear your voice and listen to your much expertise there. According to a recent, most of you may have seen this survey by AmCham China, 38% of U.S. businesses are reevaluating their operations in mainland China right now. Options include sale of operations, supply chain changes, operations, outsourcing, shutting down, relocation. I'd like to take just a few minutes this morning to talk about the sale option. That's what we do. And it often is a preferred option. Legacy costs, potential liabilities often stay with you in a number of ways if you just do not sell your company. And a sale can often minimize those liabilities. Liabilities include employee terminations, typically require severance packages, payment of taxes, other social benefits. Leases need to be negotiated or terminated from oftentimes a very weak position. If you received any preferential tax treatment and setting up, you may need to repay that. And it's kind of important too is non-payment or non-compliance could result in danger to any of the company officers or employees should they return to China. So needless to say, a sale often avoids many of these issues, and that's what we do and have done a fair number of them in China here. Let me give just a real quick 30,000 foot overview for those of you that still remember flying on airplanes. What is kind of going on in the M&A sector in China. Q1, I just saw numbers last week from S&P Global. Q1 saw a 36% decrease in aggregate transaction value over Q1 2019. Domestic and inbound was down 27%. Outbound was down 76%. In terms of our operation here, it was not in the seller's interest. We put 4 deals on pause. We've got 2 ongoing right now. Certainly, COVID-19 has impacted buyers and sellers. From financial sponsors, PEs, we're getting mixed reactions. They all were doing a bit of triage on their portfolios, and some are now looking at growth opportunities. We have a large Chinese private equity fund we're working with right now on one deal and another deal they're very interested in when we bring it back to market. Strategics, by and large, seem to have hit the pause button. But as in all downturns, those that are the strongest and well capitalized are benefiting and aggressively looking at deals. 2 items are slowing down processes these days. One, of course, is due diligence. Nobody can travel. It's very difficult to do proper due diligence on deals. And secondly, what I call price dislocation. Sellers are not wanting to accept less than what they were looking at 6 months ago. Even though we do live in a post-COVID world here, COVID world, and buyers are looking for bargains. So it's critical that you do put a competitive process in place in terms of selling your operations in China. Another option, if you meet the strategic and financial parameters, of them is the sale of the business to PRI, Dwight's company. They have a strong history. As you mentioned, they've invested in 29 businesses in China and the ability to close quickly and, most importantly, in US dollars. So that's my quick summary in terms of what's going on in the M&A sector and some of the things that we're seeing. Turn it over to you, Dwight.
Thanks, Bob. So although we are not putting what we would like you to do in order, actually we'd love for you to be incredibly profitable and grow your business in China. We have come across companies over the last 30 years that are in desperate need to exit, but to meet all the requirements from US laws, Foreign Corrupt Practices Act, and related, and we've worked out sales agreements. Those agreements can be complete cash up front. They can be a mixture over years. They can be payment back in product as need be. I do think that, just to encourage you, that the world continues to decouple. A good friend is Pat Gelsinger of VMware, and as Pat's statement is, for VMware, you know, a Cadillac of cloud suppliers, says, Dwight, we're just going to continue to sort of separate into two different camps on the internet side and some of the manufacturing standards. So if possible, I think keeping a footprint in China is good, but if you need to sell for reasons of liquidity or US requirements, we can do that for you. And again, we are adaptable to your needs. We have the people in China. I happen to not be in China right now. I didn't say that. Scott's home. My wife and two girls were waiting to get back there into schooling and Jules' work. But for right now, until China reopens, we are here in the southwest part of the U.S. So you can sell the business to us. Those deals can close very quickly. It's just a question of getting the due diligence done and related. I would say because of our presence in China, we've never yet had a purchase run into major difficulties with the Chinese government. We do have at our headquarters in Beijing, we have about 37, 38 people there. We have a dedicated government relations team that helps in some of the approval processes for that. In Bob's case, there was a bankruptcy in the States of actually a 280-year-old company and had an asset in China, and Bob knows we can make decisions quickly there. Going to the next side, an even better agreement is if you need a continuing supply of products. So this is a sale of business to PRI with supplier agreement, this one slide up there. And in that case, we love it if with you we can guarantee, okay, for the next 18, 24 months, here's your product at this pricing, et cetera. We've done these agreements with a variety, large auto companies, large telco companies, large semiconductor groups. We've signed agreements 1 to 3 years. This seems strange for the US, but in China, it's very normal where they're wanting a dedicated supply, and we give credibility. They have assurance that, hey, PRI is going to do this with their management teams. And I mean, in one case, we did a 3-year agreement with a very critical component for an international company in the telco area. So we love it. We're okay, because manufacturing, you don't want to shut down. A factory not producing product is horrible to manage the people, et cetera, the learning curve. And so it's ideal if you want to sell the business, but you can say, okay, for the next 18 months, we'll agree to do this. Right now, we're looking at a close down of one factory. They have a thermal heater control temperature device, smaller customer, small 7 figures per year. And we're working on an 18-month agreement with them to guarantee a continuation of supply of that product. Okay, next slide. The outsourcing of management options. So in the outsourcing of management options, we've had probably about 8 to 10 of these. You may have right now a factory in China and you've had no non-national leader, probably a Western leader or leaders come and visit the factory. And I will tell you the workforce in China is young. We have, we've had about 18 or 19 technology partners in the US, Israel, Europe that we work with. Those international tech companies, employment 100 to 8,000. And when we've done studies of the average age of the workforce in China versus the workforce in the US or Israel, it's clear that the US and Israel workforce is older by somewhere between 4 to 7 years. So the workforce in China is young. They do need encouragement. I will tell you, Zoom by itself doesn't cut it. You need people on site. If you have an operation in China today and you need somebody there Friday of this week, I can have a senior Western manager on site by Friday of this week if you need. At a minimum, you need checkups on that. We have found, so now in our 29 operations, we've learned a lot of lessons. We have shut down 4 of our own operations. And one of those for us is from a technology culture perspective, we needed non-national people there, at least 3 from 3 different countries or zones in the US to be part of the team and to just keep the culture. It seemed really easy if we only had 1 non-national for the Chinese workers to say, well, that's just that person. But when you have 2 or more, it's really been helpful. And I could give you some studies that we've done in that for quality and prevention of corruption, which is a significant issue. And I think we've been quite successful in that. And even several universities have done benchmarks of our ultimate quality vis-a-vis others. Clear conclusion is quality is not just automation, equipment, design, but it's very much culture as well. And in that process, if you've left your team there now and they've not had a visit from a non-national in some capacity in the last 4 months, you're going to have a slippage in certain things. It just doesn't happen. And so even among us, our 9 operations, we're having those visits to just encourage people. By the way, all of our operations in China are at full blast. I've heard several of our Western partners talk about, of course, all the indirects are not at the office. None of our operations, none, are having required stay away from the office or factory or media center there. All of our people have been able now to return from their home villages. The starting date for our productions, the earliest was February 18th. The latest was an engineering center where we had the people working from home, but by the 3rd week of March, they were back. There was one small engineering group in the city of Wuhan, and they continued to work from home until just recently. That was, as you know, the epicenter. So China's full blast right now. And the second thing is we've not had, now this will sound political in nature, but we have not had the people's declining to return to work. We've had 0 terminations. We've let some people go. We just let a project leader go actually in our shower door operation in South China here recently, but that was just for performance purposes. It was a new hire and the 90-day time period. And at the 90 days, we said, you're not what we want. Frankly, it was a culture issue, but we're not having departures. People are hungry to work and they're not refusing to come back. So that's frankly a good thing. If we failed to perform, it's not because of attitude. It's probably our stuff. So we've had people say, just take over the management of an operation. And we've done that. We can do that based upon risk portfolio simply at how do we results. We've had people pay us fees for that. So we welcome and can do that immediately. So if you've got an immediate need, we can have somebody there within 48 hours in any place in China. The people are already in China. And at this point, travel within China is arguably unrestricted. There are a couple, there's, as you know, 200 cities of 1 million or more in China today. There's a few districts that are having a little bit more hurdles to go through, but in essence, you're not having any quarantine period on return to home cities or going to places within China. So in that sense, it's wide open. Okay, next topic, which is unfortunately the one we don't like to talk about, but that's shutdown of operations. And let me describe basketball. So I played semi-pro basketball in Taiwan, still play with national level players in China. And when there's a fight, and there's lots of fights on the court, the fights are broken up by two parties pulling each of the parties away and somebody in the middle getting in the middle. It's a face-saving mechanism. Punches are not thrown very seldom. They are times, but they need mediators, so they need face-saving. In a shutdown operation, it's a losing of face to both the city, the local government, to the employees, to the landlord. If you're renting a facility, hopefully you own your own land, and to you. And so you need intermediate people there to talk to the tax people, et cetera. So our group, headquarters group, does this for third parties. And I'll tell you, when we shut down, we hire third parties. It's not that you're incapable of it, but there's just a lot of things where it's anticipated in that mediation, arbitration-like setting to have a middle person. So we can step in there and help that out. There's a lot of procedures. It is a complex procedure. Unfortunately, China has not significantly developed, even under WTO, there was some commitments here implied for bankruptcy. I will tell you, I think the US has a lot of issues and shortcomings, but when it gets to remediating sick organizations, our bankruptcy processes are fast, and that's a good thing. China is not that way, and shutdowns take anywhere from 5 months to 3 or more years. There's mandatory for certain size of companies reviews of the last 3 years of financials, and a tax person can just have a thorn under his fingernail just wanting to get at you. They had a relative at the operation or something. And so it really takes a political finesse as well as others there. So we can help with that. I think as you look at supply chain, if you're shutting down an assembly operation, you got tier 1, tier 2 suppliers underneath, and you want to go to another country outside of China to do the final assembly. You need to maintain those relationships. The connections between suppliers up and down the chain are significant. Late last year and early this year, we worked with a US company, 90+% dependent upon a Taiwanese supplier. And one of the questions was, well, that Taiwanese supplier is buying from 15, if you know anything about Taiwan, a bunch of small family companies. 25 million in population, 15 million registered companies in the country. And they're like, well, we can just buy, and like, no, the world's too small there. So maintaining relationships with suppliers is important and needs to be done. Okay, the next one, we'll talk about the relocating to another low-cost country. Just a couple of thoughts here. First, you got to do your numbers. This is the one that is a little bit Shakespearean. It may be full of sound and fury, but signifying nothing. when we have done total cost analyses for families of products with the move from China to another Asian, Southeast Asia, ASEAN country, we have been surprised that roughly half of those have indicated we're not going to achieve savings unless there's a U.S. import duty. So I want to, before you jump, and as we know, life is complex, and you look at financials, then now you look at government to government. We've just talked about the challenges, but do not be surprised if you have an independent total cost analysis done and you take away the equation of a U.S. punitive import duty of product made in China versus that you're actually going to save cost. And so you want to look at this. And again, secondly, if you have markets within China, you know, clearly what Bob mentioned in AmCham China, they do annual surveys and analyses. And as we look at things, one of the unchanging realities is by far the most profitable companies in China, U.S. companies, are ones that have both an export market and a domestic China market. As an example, this morning before we started, one of our equity holdings is a company doing on average $50 to $100 million a year in Suzhou, a specialty chemical group. And that group's business, that was always one of our best barometers for how business is going in China. That company's going fine right now at this point. So if you want to sell in China, made in China or design in China are there. So if you relocate, make sure you do your studies. We have a nice cooperative agreement with a group called Tractus that has operations in 6 of the ASEAN countries. And we're happy to service you there to help support you in that and to look at total cost in that area. Okay.
Thanks, Dwight. That was some good insight. So we got about 11 minutes left or so, according to my timer. So I'm thinking we can hit on a few questions that were submitted. The first one that I have here is probably more for Bob. Bob, I know you mentioned how deal flow had been in China in the first half. What is the expectation for the second half of 2020?
I actually am quite optimistic in terms of what we're going to be seeing the second half of 2020. As I mentioned, domestic interest is up, whether it's private equity. I think strategic is going to, in terms of Chinese strategic, I think that's going to increase as well in terms of certain sectors, certainly information technology, online stuff, medical, of course. So I'm actually relatively optimistic about the second half of the year in terms of Chinese outbound. I don't think that's going to spring back to any large degree. And inbound in terms of from the States, I really don't see anything significant there either, but I'm optimistic in terms of what's going on in China.
Great.
And Kevin, if I could just add to that, if you are looking for a Chinese buyer of your U.S. operations or having a Chinese buyer involved, anticipate at least 2 really big issues. One is it takes a lot longer. They're sniffing around. They're trying to get financial and technology information. The number of U.S. companies that have been, quote unquote, they feel burned by Chinese potential buyers is just huge, and be very cautious of that. The second was one, I'd like to give a personal story here recently. One of our new investments is in a PVD, physical vapor deposition, very high technology based for, frankly, what we feel would be a revolution in one of the auto parts areas. That division, so we had given money to the group under an initial loan, but conversion to equity. And lo and behold, about 3 months into it, they came to us and said, boy, we've got a guy that wants to come $10 million for 20% of the company, a Chinese private group. And we said, well, tell us about it, you know, and of course, ultimately the trail led to the national government. And this group had invested in at least 3 other US technology companies. All but one have already gone bankrupt, but the technology is now being used in China. And so I think CFIUS, if you're familiar with that, and some of the restrictions on certain technologies with Chinese investment, I would just want to echo Bob's thing. I'd be incredibly cautious about looking at Chinese investments. Our own history, again, we're unique in sort of the family and culture that we have, but our experience has been that we had 7 joint ventures with Chinese equities in the 90s, and in 1999, we just said never again. It was same bed and different dreams. So we have marketing partnerships, but at the core technology manufacturing level, it's a tough road.
Those are some very good points, and I want to echo Dwight's comment there as well in terms of our antennas are always up in terms of Chinese buyers. Oftentimes there's no intention to acquire. I've had 2 stories in particular where they came in with a very good offer, no intention to buy, but every intention to get as much information as they could out of due diligence. So we're always sensitive to that.
Yeah. All right, let's move on to another question here. Per the last slide, with companies from Japan, USA, Europe pulling out of China, which emerging market regions or countries will benefit from such relocation?
Yeah, so, you know, that one, let's take a macro perspective. In the last that we did with an AmCham survey of our members, by the way, Vietnam, the answer would have been different a year and a half ago. It would have been Vietnam. Right now, Vietnam is really up to here in terms of capacity. It's very difficult to hire qualified Vietnamese in Vietnam right now for startups. So it's almost, I would just say no. Surprisingly, it was Mexico, the Philippines, and India.
Interesting. What are some of these low-cost countries doing to attract businesses that may be reevaluating the location of their manufacturing operations outbound from China?
So we just were in negotiations for one of our own investments in the Philippines. So let me say that they financed a 100,000 square foot building at very low interest rates over 8 years. They gave us 0 income tax for the first 8 years. I'm sorry, for the first 5 years with the rollover to 10 years. We think we'll get the rollover 10 years. So it wasn't as many as some places we've had in China, but it was actually a greater amount. So no national income taxes. That just gives, and then some benefits on financing construction of factories. In most of these places, do not anticipate going into a rental facility. The build to spec that's already done is to upfit. It's just going to cost you 70% of what you would have spent anyways. Don't do it. So now that the negative is you got to wait 12 to 15 months to be ready for an average building with some customization for your production process, but that's the better way to go.
All right. Let's get another one here. Okay, so you talked about India, you talked about a lot of Southeast Asia, you talked about Mexico. What about businesses coming back to the US rather than locating back to other countries?
You know, it's called reshoring, and frankly, there's a lot of proponents of that. I will just give an inductive answer that may not be statistically significant. I'm not seeing that. I think that people may be moving certain production lines or capacities, but not whole operations. Most people need a 2-option solution in manufacturing for just both market needs and cost structures and their supply chains. you know, look at, okay, the Thailand floods with the auto parts and the real hit that the Japanese auto companies took there a couple of years ago. Look at the shutdown of Michigan factories for some key components for a variety of reasons, a strike or a fire or something. Again, you got to, each industry is different, but you need to look at it and say, I think, you know, yeah, costs are higher with two, but having at least two alternatives are there. I'm seeing a very limited, and again, if we're talking ITAR, Department of Defense related activities, okay, something different. That's a government mandated type of thing. So.
Yeah. All right. Next question, probably more for Bob. Bob, how are companies adjusting valuations based on COVID-19 impacts to earnings?
Well, I guess it depends if you're looking at it from a buyer's perspective or a seller's perspective. If I was going to put out a general comment, I'm seeing offers now that are probably 20 to 30% less than what I was seeing 6 months ago in terms of numbers from a lot of buyers. Not all industries, not all types of deals, but that would, if I was going to pull a number off the top, that's kind of the post-COVID adjustment number that we're seeing in terms of valuation. So there's a little more work involved in terms of getting buyers and sellers together, because we've got buyers now that are saying, hey, this is not what it was. And we've got sellers saying, hey, I've still got the same company. The whole world went through a blip here for 3-4 months, but we're going to be back on it. So it's a game.
Right.
Yeah, and Kevin, I just would add to that. Bob, again, you correct me. I think if you're going to be the seller, you better look at the buyers very carefully to see, can they really get the financing done?
Absolutely.
This is not I mean, listen, we got lots of private equity guys on the phone. They can know better, but this is not a great environment to raise financing. And so the traditional, I'm going to borrow 45 to 60% of the purchase price environment. The cost structures make it frankly pretty difficult right now, and a lot of people just aren't doing it.
Right.
Agreed.
Well, I've heard one of the metrics that I heard was EBITDA, earnings before interest, taxes, depreciation, amortization, and COVID-19. Okay, I think we got time for about one more question here. The last one, probably for Dwight. Dwight, what's the typical time frame, would you say, to fully shut down operations in China?
It's complex. So minimum of 5 months if everything is in order, and but 3 years, and expect a lot of problems with employees, personal, frankly, safety issues, tax issues. It's if you can offload that burden on somebody else, do it. It is an emotional headache. So 5 months to 3 years.
All right, great. So we have about 1 minute left. So I kept my promise of 40 minutes. I'd like to thank our presenters and everyone who joined us on this call today and skipped watching Steve Mnuchin and Jerome Powell Senate testimony this morning. Hope everyone found this very informative and entertaining. For additional information, for any questions that we didn't get to, please follow up with either Bob or Dwight. Their information's on the last page of the slide. Thanks again, and everyone have a great day.
Thank you.